Impairment charge. 2 words no investor likes to hear. Every time it's said, it seems the market starts to panic. And it feels like impairment charges are occurring every day to a new company. But should you be worried? My name's Scott. I've been a corporate accountant for 10 years. Let's get into it. First, let's talk about what impairment is. So impairment is the writing off of intangible assets for a company. What does this mean? What is an intangible asset? It might be easier to look at depreciation. Depreciation is much more known among investors. Say you have a car. A car is a physical object. Therefore, it is a tangible asset to you. However, once you buy a car from a lot, it does not stay the same value. The value goes down over time. This is called depreciation. Depreciation is the lowering of value of a tangible asset. Impairment works pretty much the same, except instead of tangible assets like a car, it deals with intangible assets, something you can't touch, usually goodwill, but can also include poor investments made by a company. Impairment accounting really came about because of the dot-com bubble. You see, a lot of these internet companies would make investments in company and park it on their balance sheet as a high-valued intangible assets. What the investors didn't know is a lot of these investments by these companies weren't worth anything. But investors really didn't know. And because it didn't cost the company anything to write off these charges, investors were left in the dark. That's where impairment accounting can help investors. You see, the fair market value is determined of these investments, and if they're deemed worthless or decreasing in value, it is now the company's responsibility to lower that intangible asset amount on their balance sheet via impairment. So, if you invest in a company that just so happens to have a large impairment charge coming, maybe for goodwill or maybe for a very bad investment that they made, something like a Marlboro investing in Juul, should you be concerned? Well, there usually is an initial panic just because the bottom line or the profit is going to massively decrease. And this is just because whenever a company has to do an impairment charge, this does hit the PL, the profit and loss statement, or the income statement. So you will see it impacting the bottom line. However, this is why I believe the cash flow is the most important piece of a company to analyze. On the cash flow, you will see impairment charges come up on a separate line. So you will know what your operating cash flow is minus any impairment charges. So you can see, is a company still healthy despite this impairment charge? Because the company doesn't lose any cash on an impairment charge because they've already paid the investment amount up front. This is strictly affecting their balance sheet, their equity, their intangible assets, and hitting impairment charge on the income statement. So as an investor, it should be noted that while impairment charges are important, if a company is massive and has a lot of cash on hand and a lot of other investments that are not decreasing in fair market value or getting written off via impairment, then it really isn't that big of a deal. However, if your company is doing massive impairments on many investments, it might be a little bit concerning, especially if their free cash flow or their operating cash flow is also in steadily decline. That means that their legacy business is still not performing up to snuff. Meanwhile, their new investments that they're trying to do to diversify or add to their portfolio are not working out. They're getting value to zero and they're taking huge impairment charges. So a one-time impairment charge usually doesn't mean that much. However, if you see repeat investment impairment charges from a company, then it might be time for cause for concern. Each case should be looked at as an individual basis. Sometimes impairment charges are so large that it really can tank the price of a stock. And sometimes they're insignificant, like the Johnson & Johnson impairment charges that they usually have to take off for lawsuits. They write it off and they move along. So it's important to look at each case individually. Hope you enjoyed this video. I'm Scott from Road to Retire. And if you like this, please subscribe, like the video, and I will see everyone in the next one.